6. And that was something a lot of people were actually watching for. Now, what's interesting here is that the employment numbers really needed to surprise materially for a significantly strong move, either higher or lower on equities. And I think that that was a key. For instance, the options market was pricing in only a 65%, 65 basis point move for the markets on this jobs numbers, which was actually way lower than normal for a Fed meeting, for a jobs numbers, which is odd because it was a relatively important one. But a 50-point move, we barely budged. This is an hourly chart, and the reactions here were a stock market that strengthened here like 10 plus points. We're still relatively flat. By the way, you do need to watch the March futures contract, because the continuous chart looks like it's up 64 points because of a contract roll. Don't let that be fooled. The market is not up that much. It's only up 6 points, relatively flat first reaction. And so the one thing I was very adamant about, if this just came in line, it would be a nothing burger, and it would very likely mean that option expiration gamma pinning will prevail this week. What does that mean? Well, there's a huge open interest of options that all expire this Friday. And what ends up happening is that dealer positioning causes them to have to go long or short a certain amount of stock because of their gamma exposures. This creates actually a pinning effect where they're selling into strength and buying into weakness, which pins the market. Think of it like a gravitational pull on a planet. And once you're near that strike point, then the market stays pinned in that area. The jobs numbers was really kind of the last thing that could have like moved the market out of the gravitational pull, and it so far has been a nothing burger in terms of it being in line and almost very little to no reaction on the market. So let's talk about what we know. One, that during the FOMC, Powell clearly was dovish in terms of or at least everyone was expecting this hawkish cut. And his concerns about the labor market were far greater than the risk of inflation accelerating. And the interesting thing, he talked about the fact that jobs were likely overstated by 60,000 a month in overcount on payrolls. That's coming from Powell. And that's interesting because we literally were up just 64,000 jobs. So very likely that the jobs number is actually much closer to flat after revisions. And that is going to be the focal point. Will the question be is this going to lead to more dovishness next year? With the policy near neutral here and 3 rate cuts now behind us, the market is right now pricing in 2 rate cuts this year. We're going to switch to the rates markets here and see what has changed. I have this little red line showing where the stock market was before the number. You can see very little reaction on the stock market. This is not at all where anything exciting is happening. Now, the last note, with the gamma pinning coming into Friday, we have a unique situation where this year Christmas falls more or less in the middle of the week. It's not Wednesday, but it's Thursday. But it will both the Christmas week and the New Year's week will have shortened period that will feel almost exactly like a Thanksgiving long weekend. And generally, with many people taking it off, the volumes go really low, and there's a huge gamma pin strike on the JP Morgan options whale going into the December 31st, up near 7,000. And so you have a scenario here where there is no immediate reason to see some short-term bearishness on those metrics. The only thing at this stage that I think could possibly cause some real stress points is if we see any acceleration in AI stock selling, which is not probably isn't zero. And so we're so at this stage, I would say the probability of a very boring December is the greatest probability. And we would need to see some serious deterioration in AI stocks at this point. So let's talk about the reaction to the dollar, because this was relevant to me. The most important thing to watch in my mind is the dollar. And more importantly, will we see a resumption in the US dollar bear market? And the 98 level was a huge psychological level for me. And not just psychological, but actually quite significant on the technical side in my mind. And any breakdown below 98 is truly kind of opening the window for a US dollar to resume its bear market decline. Why is this an important thing? First of all, we're trading exactly at 98 on the reaction. So seeing whether we move off this level or break through it is going to be critical. And this is a 1 hour chart on the dollar index. Why? Because what has worked all year has been, beyond the AI stock trades, has been the reflation trade, emerging markets, commodities, gold, all of these things working so well. And if the U.S. dollar resumes its bear market decline next year, and we see, for instance, the dollar index on a weekly chart basis resuming selling, and let's say heading down to 2021 and 2022 levels down below in the low 90s, this would be an extraordinarily bullish tailwind for the reflation trade assets. And it could really feed into a double down on many of these commodity bull markets and commodity stock bull markets that can get underway. It's huge. We love the commodity markets and have a big positioning there. If the dollar started to break down, it would be a huge bullish tailwind for that thesis. Now, I want to move on here, and actually, but let's quickly see gold, what's going on gold. Now, gold here on a 1 hour chart basis strengthened. Now, this it's stronger there when it was, but not by much, like a $10 rise or so. But it is important to watch whether there's going to be a gold breakout, because on a daily chart, gold is right along its 52-week highs, like ready to go. If this breaks, we could see 46 to 4,800 easily on the upside of gold. Was this jobs number leaning enough to suggest some further dovishness? If this is the case, gold will find that very bullish here. And so let's jump over to the rates markets and see what's happening in the SOFR futures. So starting off here, I want to just go to the December 2026 SOFR futures. So we're going to the end of next year, and this is looking at interest rates where they'll settle very much in line with where the Fed funds rate is expected to be at the end of next year. And so we had a clear pop in the SOFR futures, which is again dovishly suggesting that there potentially is more rate cuts now going to be priced in here. So when I put this on a daily chart, not a crazy move yet. The follow through hasn't really stuck, but I want to highlight that if any breakout above the 50-day moving average on a sustained basis, and particularly this 97 level, which is the 3% level, would really start to suggest that the Fed is going to be far more dovish, and these jobs numbers are expected to deteriorate. Well, at least initially, what you can see is that beyond the stock market doing very little, the rates markets and the dollar are actually leaning a little more on Fed dovishness and on the short term. And so this is 100% where we stand in the first reactions on this. So what does it mean to you? Well, like, how do you trade this? How do you position? Well, one, while there's a complacency right now on the very short term on the markets, I feel that complacency is generally warranted. Our volatility premiums are down along their lows, and when we were highly concerned about the markets a month ago or more or so, it was because the markets were at an edge of the cliff, and they were at the verge of triggering a whole bunch of CTA selling and other types of things that would create a very short-term liquidity-driven pivot. And we are nowhere near that at this moment. It's not that we can't trade below 6,700 on the S&P and see an acceleration begin. But with gamma pinning going on this week and two short and low volume weeks next week, really increasingly this is going to be a January story. So I think that the key thing as we move forward here this over the next couple of weeks is really spending a lot more time thinking about what will be the major stories of 2026, because there was some serious money made this year when getting right these certain trend moves, and trying to figure out how the dust is settling on this and where the trends are actually emergent for what will be the big moves is where the big money will be made. And you're going we'll be talking about it on this channel, and seeing how things play out. Now, if anyone wants to follow along how we're setting up the new year, the link is in the description below to try a 14-day trial to see what we're doing behind the curtain at Big Picture Trading. But feel free to join at any point if you're interested. The point here, S&P, very little reaction, almost no reaction on this jobs numbers, and that being a nothing burger. But now it really was and is now really a dollar story and a rates trajectory kind of story as to where are we going to go in terms of Fed policy. That will dictate where the S&P 500 is likely to go, but clearly not likely today in terms of the way that this market is reacting to this. So that's where we'll wrap it up. We'll if there's anything really moving this week, I'll come back online and give all of you guys an update. But otherwise, have a good trading day, everyone.